Hello, welcome to Tactical Trader Bootcamp's video tutorials. Today we're going to be talking about the basics of leverage. Now, we all know that the brokers offer us leverage. We see that on every website. That's pretty straightforward, but we're going to talk about another one which a lot of people don't talk about, is equity leverage. More than that in just a sec, but I encourage you to pause the video, read my disclaimer. It's a government required disclaimer. And before we continue, I just need you to understand that Forex trading is a risky business. And if you read that, then we'll continue. So, what is leverage? According to Wikipedia, leverage in finance, sometimes referred to as gearing in the UK and Australia, it is a technique to multiply gains and losses. Most often, it involves buying more of an asset by using borrowed funds, with the belief that the income from the asset or the asset price appreciation will be more than the cost of borrowing. Okay, basically, our terms, it's the ability to do more with less. In this instance, we're going to be talking about leveraging other people's money. So whose money do we borrow? The brokers. Excuse me. How do you think you can trade a $10,000 position with only a couple $100 in the account? Because the broker puts up the majority of the trade, you only need to put up a 1/100th of the trade. Why? Well, the broker can take better commissions through the spread if you're leveraged, and also by giving us the ability to do more with less, it gives us more profit and or loss. The profit is much more appealing. For example, 6% profit on a $1,000 account is $60, you know, which is only really 60 pips at my full trading leverage. You can get that over a couple of hours with a leveraged account, but if you traded with no leverage, you would need to take essentially $10,000 to a cashier, and without taking any of the commissions into effect, hand over $10,000, wait a couple of days for a nice movement, and then take it back out. Hopefully you've got 60 quid better off. So, but we don't want to do that. We want to utilize leverage. Leverage is good as long as it's geared correctly. So, let's get into a little description about leverage. Your head might start hurting in a little minute. That's okay. We'll get through it. Okay. Right. So we're just going to pretend that this is Euro US dollar, and this was the price yesterday, 1.2150, and then this is the price today, 1.2090. The difference in the Forex is actually 60 pips, so that made a 60 pip move. In respects with the cashiers, the price only moved 60% of 1 cent. So not even 1 cent the price moved, and we're able to catch our 60 pips. For every 1 cent of movement, there is 100 pips. Okay, that's another good reason why we like leverage. So, from this we took 60 pips, and if you were trading one full mini lot, that would be $60. Now this could have happened over a couple of hours by using leverage. But if you didn't use leverage, I always use the concept that if you go into the money shop, pretend you're going on holiday and you need some dollars or you need some Japanese yen, so you go into the post office with your base currency. For me it's the pound, for you might be the dollar. So you go in there with your $100 or $10,000 and you say, I want to change this into another currency. In order to get this $60 profit, you would need to walk into that shop with $10,000, okay, and for the same price movement, 60 pips, that's what you would need for the difference to be $60, whether it's profit or loss. Okay, but when it comes to trading on the charts, we could be trading a $1,000 account, okay, and just put down £100 on the table and be able to gain this. Okay, that's a great thing about leverage. Leverage is good, and this is the form of leverage that comes from the broker. He will offer you 50 to 1, 100 to 1, 200 to 1, even 400 to 1. We'll talk about that in a little second. So there's no denying it that we need leverage in trading. It's a good thing. Abuse it and they can work against you equally as fast. Okay, so on to the fun bit. I just want to state something out right now, that one full mini position size on the market is equal to $10,000 contract size. Okay, so that's what hits the market, and you gain the profit or the loss from that $10,000. Now, this section right here, we're actually going to be covering equity leveraging. It's essentially leveraging the money that's in your account. So this is what we use on a trade-by-trade basis. It is your decision to deploy a percentage of your capital for a percentage gain or loss. We can change how much we leverage. We apply to each trade by simply changing our position sizes. Okay, I'll just jump to this chart. So before we even start trading, we define what our trading system allows us to be one full position size. In this instance right here, as usually when I do a description, my full position size is 30 pips. Okay, so 30 pips is 100% of my trading style. With that in mind, so I've got here 30 pips. So the balance would be $1,000. 3% risk of that $1,000 is $30, and 30 pips is my full position size at risk. So $30 divided by $30 equals 1, which is one full mini lot. Okay, you should all know this, and it's all explained in on the Forex Money Manager spreadsheet and other videos. But with that in mind, if our 10 to 1 leverage is 100%, one full trading position size, which is $10,000 on the market, 30 pips a risk, which is $30. If I've ever wanted to decrease risk, because I just didn't like the move, I wasn't 100% sure about it, what I would like to do is cut my position size in half, which this is actually cutting your leverage in half. Okay, so our leverage is just gone to 5 to 1. So for every $1,000 in the account, we're now trading with $5,000, and 10 to 1 leverage, for every $1,000 in the account, you're trading a $10,000 account. Okay, so it's 1,000 times 10, that's where that comes from. 1,000 times 10 equals a $10,000 contract size. Okay, so if I wanted to cut that in half your leverage, this is actually going to change your position size naturally. So what this is it's trading a $5,000 contract size onto the market, still risking 30 pips, and it's cut the risk in half to $15. Now you don't need to know all these. I don't trade 9 to 1, 8 to 1, 7 to 1. I just do 10 to 1, 5 to 1, and 2 to 1. Okay, all depending on basically the pips at risk, or whether you're not so sure of a trade, you know, just cut the position size in half. Okay, we'll jump over to the charts in just a sec, just to have a little talk about what you actually need in your account. So we're just going to open up this demo account. We're going to open up at 100 to 1 leverage. Now, like I said before, brokers will offer you many different kind of levels. So we do want a form of leverage. Some of my trading accounts I have 50 to 1, others I have 100 to 1, but I definitely wouldn't trade with more than 100 to 1 leverage. So we're just going to set this at 100 to 1. Deposit of $10,000, and let's open this up.
Incoming mail.
This demo account is actually opened up as a standard account, not in a mini account. So the difference with that being on our descriptions in the last couple minutes, we're comparing mini accounts. So a mini account contract size is $10,000. Now a standard account, one full lot, is $100,000. Okay, need you to understand that. So what we're going to do with this, so we've got $10,000 in account, equity is $10,000, free margin is $10,000 because it's brand spanking new, no trades being placed. So just bearing in mind that I'm just about to place a trade on for one standard contract onto the market. Buy or sell doesn't matter. Okay, right, we've got a buy on the market, so we've now got $100,000 on the market, and we take the profit and the loss from the fluctuations of the market. Now just bear in mind that there's 100 pips in every cent, and we'll see the price on here, but you know how it works. But what I want to talk about is the margin. So the margin for this trade for $100,000 is $1,076 dollars, sorry. Right? We've only had to put $1,000 on the table to trade with $100,000. Bearing in mind that your free margin, this fluctuates with the profit and the loss from that trade. But you've only had to put $1,000 on the table. The broker puts up the other $99,000 in order for you to trade with $100,000. Like I said, this is beneficial for him because the spread, this is where the brokers get their commissions. If we were not leveraged, they'd only be taking a few pennies, you know, a few pennies off each trade. With us being leveraged, they can gain, you know, pounds or dollars instead of actually cents. So it's beneficial for them. They'll never ever lose any of that, the majority of the trade that they put up. They've got no risk whatsoever. You've got all the risk, and it's all shown up here in the profit and the loss section. Okay, so the broker never risks, he only gains. It's you that takes the profit or the loss. So I encourage you to go along to get yourself a demo account. Anyone, doesn't matter, just open it up and just have a little play about with it. Figure out these the margins, your free margins, how much you can actually trade with. What I do recommend you do is open up 3 different accounts. Open one up at 50 to 1, open another one at 100 to 1, and open another one at 200 to 1. put a deposit amount of something that's going to be roughly what you're going to deposit into your account. So if you're going to deposit $1,000, trying to open up a demo with $1,000, or 3,000 or 5,000, something relatively close. Don't open up 100,000. Just so you get a real feel of how the fluctuations of prices are actually going to work. And then just watch these numbers down here for each leveraged account. So I would say go for the midterm, 100 to 1 leverage. 50 is ideal. But yeah, just go for it. Check out these numbers. Just pay attention and place a few trades. You'll see your how many trades you can actually place on a certain margin. You can see your free margin down here. Watch your balance. You'll figure out that if you get a 50 to 1 trading account, you might only find that you can place 4 or 5 trades on before things start maxing out a little bit, especially if you're fully leveraged. But if you go to a 200 to 1, you'll find that you can put more like 8, 9, 10 trades on. Although this might sound good, could you imagine if those 8, 9, 10 trades started turning against you equally at the same time, because you were on a non-farm payroll news announcement, which is very real. It does happen. So that's why leverage does have a bad side, because if you're on the wrong end of the sword, you can get caught with your pants down, and that could be embarrassing because you could lose a damn good portion of your account. Okay, so I'm hoping that we covered this sufficiently for you to understand a little bit about leveraging. It is a funny subject to get into, but once you understand it before you get into the trade, you don't need to think about it after, because all you're going to be comparing is your balance, current balance, with your position size. Once you've worked out all the formulas that you need to work out, it becomes second nature. But all you need to do is understand the difference between broker leverage and equity leverage, and just understand that there is a force that's invisible working in the back. Could be working for you, could be working against you, and just be aware that it's there. Okay, so thanks for watching. Now, if you want more videos, go to tacticaltraderbootcamp.com, where we've got plenty of other great information for you. See you on the next one. Thanks.